Hi, I'm Mark King, Head of Content for EMEA at Columbia Threadneedle Investments. Joining me for this one-off special from the Eye of the Needle podcast team is Toby Nangle, Global Head of Asset Allocation. And we're going to talk about Covid-19 and the extraordinary year we've just had, a year that challenged families, companies, markets, economies and governments. So welcome, Toby.
Thanks very much, Mark. Nice to be here.
Toby, before we get into the subject, can you just talk us through what you do here at Columbia Threadneedle Investments?
Sure. I manage portfolios. I also run the asset allocation business area. So about a third of our client assets come in the form of some form of asset allocation mandate, and I oversee that area of the business that looks at that and then sets investment policy for that.
Okay, so we're just over a year on from when lockdown first started. If you remember, Toby, I think the rhetoric around this new coronavirus did begin to change in early March last year. On the 5th of March, the first UK death from the virus was sadly confirmed. And then by the middle of the month, we'd all begun to work from home. The Premier League was suspended. Local elections were postponed for a year. And of course, on the 20th of March, the Prime Minister ordered that the cafes, pubs and restaurants must shut. It was takeaway food only, if I remember rightly. And then 3 days later, the lockdown was introduced. So what are your memories of that time? Because developments were so fast moving then.
Oof, I mean, they seem pretty fast moving for all of us, really. I mean, it was astonishing, really. We were looking at how SARS was spreading and the kind of market impacts, and it was all quite abstract and academic and markety. And then suddenly it started to come very much into real life, as you say. It was the fact that schools were shutting. It was the fact that we had our work from home test environments that suddenly became open-ended. It was an astonishing period for everyone, and it was I don't want to say chaotic, but there was a lot of things that were moving very, very quickly, and we were all trying to battle on a number of fronts, on home fronts, on work fronts, with clients, helping them through this time. And so it was really quite a stressful time.
It was, and I do remember some of that work that was done on previous viruses and pandemics to try and extrapolate what the impacts might be. There was a lot of that going on, wasn't it?
Yeah, I mean, if you think about, like, people talking about it as a new SARS. And so SARS was something that many of us were managing money through. And it was something that happened somewhere else. And people talk about it being a global pandemic, but the idea of there actually being a global pandemic which shut down the entire world was not really something that I was looking for. And then we needed to kind of respond to the surprise, really. I mean, it was a surprise to me. If we'd have anticipated this and looked back at in February and said, well, obviously the world is going to go into a 12-month shutdown, we would have behaved, I think, slightly differently. But we were responding to facts as they emerged, rather than the ideal thing, which is to anticipate all of those facts as we were going into that kind of period of uncertainty.
And do you remember how markets were responding to the early days of the crisis?
Yeah, so markets in the very early days, say pre-crisis, but post-viral outbreak, were much in the same place as us. And then very quickly, they went kind of berserk. I mean, you had liquidity absolutely vanish from corporate bond markets. And one of the wonderful things about being Columbia Threadneedle is that we've got insights across the globe as to how trading conditions are evolving and what's happening in different regions. So we could see liquidity literally drying up in other areas. And there's huge, profound economic uncertainty as governments shut down. I mean, there were those early narratives that it's not the virus that we're worried about, it's the government response to those viruses. And those look now to be very misplaced, those views that we had. But we were looking specifically economic aspects. But when we look to see governments intervening to shut down economies, we started quite quickly kind of thinking about, okay, well, what's going to happen next in the real world, and how's that price, and are there disconnects? And that first bit of like, what's happening next in the real world? Well, we've got a lot of analysts around the world and smart investors who are looking at this. But to be frank, we didn't have a great idea about what was going to happen next in the real world in terms of corporate profits, how short the outbreak would be, how long it would take to create a vaccine, how quickly the world would adapt. But we did have some insights into how that was being priced and what government policy reactions could do to that. And what do I mean by that? I mean, I guess what I meant was going back to that sort of corporate bond illiquidity. We've developed over a number of years different ways of looking and measuring illiquidity and what that does to asset prices. And we saw a real collapse in illiquidity, and that filtered across all asset prices, in equities and in fixed income, also in other markets like commodities and also currencies. And we saw the markets being quite joined up in the way in which they were responding. And we saw that central banks did not have the power to cure the virus. They didn't have the power to prevent a recession. They didn't really have very much power on many things, but one of the things they did have power on was to restore liquidity to the markets. And so we made a series of quite bold investment decisions which were about that insight, and that actually helped navigate our clients through in quite a good way the pandemic, because we were focusing on the things that we did understand and not trying to guess about the things that we didn't understand.
Yeah, that makes a huge amount of sense. Let's dig a bit more into what governments and policymakers did, because with the lockdowns happening, businesses shutting, economies frankly in danger of collapse, and people facing unemployment or loss of earnings. What remind us what the government did to prevent those things happening to an extent, and did it work?
So yeah, there were kind of two different angles, or probably more than two different angles on this, but two main angles. One of which was the sort of things that, really astonished me, which were things like the furlough scheme in the UK and similar programs across Europe and the United States. I mean, in the United States, basically the unemployment and furlough-like, things that were going on, providing checks in the mail to people, meant that actually last year household incomes were higher than a normal year because there'd been so much government money being sent out in the post. So households were really, they were extended a bridge to get through and get over the economic shock that came with shutting down economies. And so, and similarly in the UK, while there was a hit to households because unemployment did rise and furlough schemes didn't compensate people for all of their lost earnings, but it did provide a big bridge to get to the other side. So those were things that surprised me. I thought that actually they were really appropriate, and they did help, and they do help bridge from that uncertainty. We're being hit by a virus, shutting down the economy, and we'll get to a point whereby we're vaccinating people at some point, and then we can reopen. And that was a huge, big thing. But the second thing was on the monetary policy side of central banks, and that was something which, to be frank, didn't surprise us. It was following a pattern of policy that they've been pursuing for a number of years. And it sounds really, really, really silly to say this, but the global financial crisis was bad in so many ways. But one of the things it was good for was bringing up a whole array of new policy tools that didn't previously exist. So you look at all the different policy tools that were rolled out in the global financial crisis. It took about 24 months to roll those all out. And probably in this pandemic, it was more like 24 days.
Yeah.
Because that tool set had already been constructed in the global financial crisis. And so just bringing that on board and being able to respond very quickly. We knew that they were there. We knew that they could be used. We thought that they ought to be used. And we thought that was in line with what policymakers would be doing to best get the economy through. And so we were investing on that basis. And then when they came through very quickly, we were, first of all, reassured that they were doing what they were supposed to be doing. And second of all, we were reassured that actually prevented the global health crisis turning into another global financial crisis. Yeah.
Were you surprised at all by the extent of the intervention and what that might mean going forward in terms of borrowing?
Yeah, so I mean, the furlough schemes, they did surprise me. And the checks in the mail, the size of the US checks in the mail surprised me. They don't immediately worry me about borrowing really very much at all. And I guess there's a couple of reasons for that. Number one is because the alternative is not to do that and to send the economy into a huge contraction, which will be a worse outcome economically, and for humans. It would be a really big policy mistake not to do that, in my view. But it did surprise me, the boldness that they did that with. Now, does it worry me about the debt side? Not so much, because interest rates are very low, and that might change, and maybe we'll come on to that. But the amount of money or proportion of government spending that's actually going to debt service, despite debt going up, has been shrinking still, because rates are so low. So governments went out and borrowed at super low rates, unprecedentedly low rates, and the debt service attached to that is very low. Now, at some point, you could say they have to pay that back. But what tends to happen is that economies kind of grow, and that growth shrinks the kind of stock relative to the economy, rather than kind of, we borrowed £100, we now have to pay that £100 back and get back to where we started. I think that's less likely.
Before we talk about the future, let's just talk about your work as a fund manager during this, because you worked in your career very differently up until now. All the ways you had worked were suddenly thrown out the window, from company meetings where you would have gone on site to meet finance directors or chief execs about their plans for the companies you invest in. Even the water cooler moments in the office were no longer part of your working life. How difficult was it to be a fund manager during this time in the last year? And did you find new or perhaps even better ways to work personally and perhaps with colleagues?
Well, I mean, I'll be frank, Mark, I found the early days really personally very hard. I mean, really very hard to make that transition to working from home. There's a lot of things that I relied upon, and the team that I work in of investors within my kind of direct reporting area, and also more broadly, were hugely important for me and enabled me to kind of make that transition. So it was very difficult, because, as you kind of alluded to at the beginning, it wasn't just that we were working from home. It was suddenly that I've got 3 kids, the youngest of whom was 7, right? So I'm homeschooling a 7-year-old, a 10-year-old, and a 12-year-old at the same time that we're moving to work from home remotely, try to deal with a huge amount of uncertainty around the global health situation and financial markets. And so I remember sort of being in management meetings, which I knew were going to last for an hour or so, where we're thinking about how we kind of construct this thing around the firm, and doing that from my phone with my headphones on, while kicking a football with my 7-year-old, because everyone had to multitask at everything all the time, right? And I'm really proud, looking back, that we did such a great job for clients, because the pressures that we were all under. And I think this is certainly not unique to our industry; it's common across all industries. Were profound, and have my wife works, and so we were both working. We'd get up. One of us would get up at 5 to do a stint, and then one of us would sort of end at 1 in the morning, and so we could be tag teaming all through the day between homeschooling kids and working full-time jobs. And so, I found those early days really, very, very hard. But thankfully, I worked with fantastic colleagues who also, under difficult circumstances, were able to collectively pull together the kind of insights, make sure that our investment processes were never interrupted, and that all of those things that we say we're going to do for clients, we were able to do that. We were able to gather those insights, able to have those external interactions and internal interactions. It just was a bit hectic for a couple of months while everything was, piling on top of each other.
Yeah, absolutely. I do remember the mornings doing the Joe Wicks workout routine with my kids before.
Yeah, I was doing those too. Absolutely, yeah.
Okay, so let's think about some trends and themes. Did Covid-19 kickstart or perhaps accelerate any trends that you were already monitoring, whether they're structural trends and challenges? What impact on that front did COVID have?
Yeah, so I mean, I guess it's a little bit of a cliche now to say that it accelerated a lot of things, but it really did. I mean, the internet adoption, online shopping, the fact that who knows what work life would look like 5 years from now if there were no COVID? But it seems very unlikely that the vast majority of people working in sort of office-based knowledge jobs will be, typically working 5 days in an office now. All of these things were accelerated, which is been pretty profound for a lot of investment theses. But then there are some things which we're probably still in the moment of, and will revert. But right now, I mean, the analysis that we've been doing across industries has been that it's been an accelerant of existing trends, maybe pulling sort of 5 years of that trend into a single calendar year. Has been kind of the bottom line. But I mean, other things such as, I'm sure that travel and leisure at some point will revert to something which looks a little bit more like yesteryear than it has done over the past 12 months.
Yeah, certainly the online shopping activity in my household has soared in the last year, which I suspect that's a trend that's across many households in many countries. So what does the future look like, Toby? Maybe let's talk from an economies perspective first. What does the global economy look like going forward now, and individual economies, UK, Europe, or the US?
So over the short and medium term, and then the long term, I guess we can split out that way. Over the short term, we're looking for some really quite profound acceleration in economic activity. Some very strong pent up demand, and as economies reopen, we're anticipating more than 6% growth over the next year in the US, which is a blockbuster number. We're seeing really strong growth coming through a variety of areas, but that also sort of boosted by fiscal, so budget spend. So governments are spending big, as well as consumers and companies still spending relatively strongly. But at the same time, unemployment's somewhat higher than it was, and so having unemployment falling from higher levels is associated with above trend growth, but can't go on forever. You can't grow above trend forever. And so it's probably, if we look out 1.5 years, that's the kind of period that we're looking for high levels of growth, and it starts to subside quite quickly at that point. And then some of the longer term trends that we've seen around demographics, relative, as you mentioned earlier, relatively high debt loads, be that corporate, government, household, might limit the degree to which that above trend growth can continue. And so we're not really convinced that we're outside that paradigm of lower interest rates and actually lower growth rates once we get past this sort of shorter term strong growth period.
Okay, that's interesting. So the bounce back in consumer spending as we return to work in some capacity, as unemployment falls, you see that as a sort of short-term boost to inflation, but not a longer-term one that might see a meaningful rise in interest rate?
Yeah, I mean, I was expressing it in terms of economic activity, but you're quite right. We could translate that straight over to inflation as well. When I speak to sort of central bankers, policymakers, about the kind, over the next few months, we're gonna see there's going to be a whole variety of price dislocations. And now I'm using kind of horrible economist-y type language. Price dislocations, which for you and me mean price rises, right?
Yeah.
And so price rises sound pretty much like price inflation to the person on the street. To a central banker or policymaker, they'll say, of course we're going to see price dislocations. We can't solve for that. There's nothing we're not going to rack up interest rates to solve for some shortage of a particular good or service in a particular area after a period of pandemic. That would be nuts. What we can solve for is inflation, and price dislocations are different from inflation. And you can stand back and go, what are you talking about? Price rises are inflation, right? No, inflation is about the kind of the environment of operating beyond potential growth that triggers wide-scale rises in prices on a sustained basis. That is what a policymaker or kind of an academic economist would talk about as being inflation. So shorter term, price rises. Longer term, that's not what we're seeing still. We're still seeing that we're in this kind of lower inflation environment. Now, there are risks to this, and there's a really important risk to this, which is possibly pandemic related. And that's there's this been chat about this kind of new economic consensus for new fiscal consensus, what the governments do. And some people talk about this as MMT, but I think more generally, you just be talking about it as the question of, are governments more comfortable running perpetual budget deficits if that budget deficit doesn't lead to perpetually increasing debt as a percentage of GDP. That all sounds a bit weird. How can you have perpetual budget deficits and not have debt to GDP rising? Well, it goes back to that interest rate points. If you have interest rates quite low and growth rate is higher than interest rates, then actually you can run budget deficits without your debt growing. Now, if policymakers say, right, well, now our new normal is to run large budget deficits every year and invest in things like, infrastructure and all sorts of other things, improved health systems, improved education, lots of things that I'd quite like as an individual, then you could start to see the level of inflation, maybe, or inflation expectations anyway, maybe rising a little bit. And if inflation expectations start to rise over the medium term because of this new fiscal consensus, then that starts to threaten that low inflation, secular stagnation sort of paradigm we've been in for the past few years. So that's a risk case right now rather than the base case. But our base case is that we kind of return to this sort of low inflation, low growth environment after about 18 months of strong recovery.
Just a quick word on emerging markets. If you're obviously looking at them as much as developed markets, are there any outliers in EM, and how are their economies faring, and what's their outlook for inflation and rates, perhaps?
Yeah, I mean, the first thing I say about emerging markets is that there's an awful lot of countries, and as such, there are some real differences between those different countries. I mean, things going on recently in Turkey have been quite unsettling from a financial market perspective. Things going on in Brazil, I think from a health outcome, are really worrying. I mean, the Brazilian health system appears to be teetering under the strain of COVID, and some analysts calling for essentially the health system to fall over completely, which would be a pretty major human catastrophe, as well as something that would have economic and market implications. But within emerging markets more generally, the areas that we're finding greatest opportunity in right now are actually in Asia. We see some really interesting developments coming through in places like Korea and Taiwan, and also in China. So essentially Southeast Asia and Northeast Asia are areas where we see are going to be supported from a risk asset perspective, so equities and the like, from stronger short-term growth that comes through, and also a diminishing risk premium that might have been associated with, let's call it the previous US leadership. So while relationships between China and the US are by no means in a wonderful place, the sense of perpetually rising risk premium in Chinese assets and the Asian assets associated with a perpetually declining relationship between the US and China isn't necessarily now our base case. We're thinking about more that risk premium might go sideways or maybe down a little bit, which would lead to stronger performance from Asian assets.
And when you mentioned US and China there, did just remind me to perhaps ask you about, you mentioned infrastructure and investments there as we emerge from COVID. Is that more likely to be on sort of sustainable projects and with an ESG focus or in your mind?
No, that's a great question, Mark, because I mean, we've spent the whole time talking without actually talking about one of the biggest developments over the past year, which has been the acceleration of move to net zero around the world. And that's been a huge source of investment ideas for our analysts, which have found their way into portfolios of thinking about the disruption, which, again, from a personal perspective, I see as a very positive disruption. That comes from an acceleration to net zero, and China signing up to more and more ambitious climate goals just strengthens the case for some of these disruptive energy names, which disrupt the old kind of carbon intensive energy usage, and also electronic vehicles and the like. So yeah, there are some, China's big enough to really matter what it does in this field, but I'm also really encouraged by by the developments that have occurred in Europe, the United Kingdom, and indeed the US on this front. And it seems like the world is actually pointing in a better direction than it was a year ago as far as these things are concerned. And we within portfolios are certainly going to be looking for ways to get our clients on the right side of that. And those come up in all over the place, whether it's something like semiconductors or autos or energy producers. There are all sorts of ways in which this feeds through to everything we do.
Absolutely. And one final question, tying together everything you've said and the experiences we've all had in the last year and bringing it back to your day job in multi-asset. What does all this mean for asset classes such as equities and bonds?
Right. So, yeah. So, I mean, the economic outlook. Why do investors spend so much time looking at the economic outlook? I guess partly is because it's going to be influencing the opportunity for companies in aggregate to grow their profitability. Very hard for companies in aggregate to grow profitability in a shrinking economy. And then secondly, the way in which we discount those earnings on the equity side or discount bond cash flows is very much related to policy. So policymakers who are indeed pointing towards trying to find the balance between growth and inflation. So if we're going to go through what we were talking about earlier, of strong economic growth over the next sort of 18 months or so, then subsiding with price dislocations, let's not call it inflation right now, over the next sort of 12 to 18 months, then subsiding. The central banks have told us that they're quite happy with that because unemployment's going to be higher than they expect it to be, and they're quite happy for inflation to run hot and growth to run hot over the short term. And they've done as much as they can do to commit to not raise interest rates, for a couple of years. And so you see bond yields with very short dated bonds are right down on the floor. Their bond markets believe that. They believe policymakers when policymakers say, we don't really care if inflation runs hot and growth runs hot, we're just going to keep interest rates low. But then the longer part of the bond market, so say 5, 10, 15, 20, 30 year bonds, they're a little bit more concerned because they say, okay, well, if you run it hot now, what's to stop it staying hot? And inflation expectations being de-anchored. And while it might not be the base case that those inflation expectations are de-anchored, there's a risk that they're de-anchored, and that could lead to much higher interest rates in, let's say, 5 years' time than we've had over the past 5 years. And so longer term bond yields have risen quite sharply on the back of this, which you could see is a reasonable response to the developments that have come through, especially in the case where we've got an efficacious series of vaccines that didn't exist a few months ago. We can really see that reopening coming through in growth and inflation. Why does that longer term bond market dynamic matter? Well, it matters if you hold bonds, certainly, and we've been selling the longer dated bonds that we've had within multi-asset portfolios sort of through last year after a lot of strength that they've had. And to be frank, we've been feeling pretty bad that we didn't have more of them going into the COVID crash because they went up by such a lot as yields really collapsed. So the price went up, the yield fell down a lot. Yeah. But when those longer dated bond yields were falling a lot, that also meant that markets more generally were saying, we put more value today on money that we'll receive in a long period of time. So if you're a growth company with earning zero today, zero next year, zero the year after that, and then $1 trillion 50 years out, that $1 trillion of 50 years out will be worth a huge amount more if bond yields are very low than if they're very high, right? So you've seen growth companies perform really strongly last year, not only because of their activities might be pointed towards things that were accelerated, but also because the present value of their future cash flows, to get it kind of technical, meant that their went up as bond yields went down. More recently, as we go into this reopening side, bond yields been rising. That's pushed down the present value of future cash flows, but the earnings have been pretty strong. So all this has led equities to kind of go choppy sideways over the past few months. as we have this battle between stronger earnings expectations, which should continue to be upgraded, and then higher bond yields, which have been pushing down the future value of cash flows. And our asset allocation portfolios are positioned in such a way whereby that choppy sideways on equities ends up in a slightly better place than just having exposure to those long dated bonds. And so we've had an overweight towards equities and an underweight towards bonds in our benchmark relative asset allocation portfolios. And for total return portfolios, what we've done is we've actually, despite the quite high valuations, we've been maintaining exposure to those kind of, those higher risk areas like equities, and shifting the focus to things like Asia, areas like Japan, where we see some benefits coming through from that economic and policy outlook that we've been discussing.
And just quickly, you mentioned growth as a style, I guess, doing quite well last year. Is that still the case, or has there been any kind of rebound of value companies?
Actually, just before the vaccine efficacy came through, that there's been quite a savage rotation away from growth towards value over the past few months. When I speak to my colleagues in different regional or global equity teams, they characterize it not so much as like growth versus value, but they're kind of being hyper growth, value, which would be associated with reopening, and then the middle section, which would be kind of quality growth. And they say that the wings of hyper growth, those firms with basically no cash flows, but become meme stocks, right? They've done really well, and then the reopening things have done really well, and then the quality growth has slightly suffered, as their earnings have come through really strongly, but then that backup in bond yields has diminished the valuation. So yeah, I mean, there has been a rotation over the past few months. That's looking to us and looking to me like it's fairly mature, but it's all kind of predicated on this big question about where inflation settles, and I think that in turn is linked to how the new fiscal consensus evolves. In the US, it's looking a little bit more evolved than it is in the UK, which is when the UK is looking actually for a lot of fiscal consolidation, with kind of fiscal retrenchment on the cards after a short-term boost. And Europe, it's still not really clear where that sits. And finally, in China, they're actually looking like they're embarking on fiscal retrenchment to get their kind of government debt stabilized a bit more quickly. So quite a mixed picture around the world. But if the pendulum swings towards that new fiscal consensus, that could be a kind of a risk case for, I think, growth stocks.
Okay, Toby, thank you so much for talking to me. It's been a hugely enjoyable chat. Really appreciate it.
Thanks very much, Mark. Lovely to speak to you too.
And that's it for this special one-off episode from the Eye of the Needle podcast team. One final thanks to Toby Nangle, Global Head of Asset Allocation, and we'll see you next time. Goodbye.
Important information. Your capital is at risk. Past performance is not a guide to future performance. The analysis included in this podcast has been produced by Columbia Threadneedle Investments for its own investment management activities. Information obtained from external sources is believed to be reliable, but its accuracy or completeness cannot be guaranteed. None of Columbia Threadneedle Investments, its directors, officers or employees make any representation, warranty, guarantee or other assurance that any of these forward-looking statements will prove to be accurate. The mention of any specific shares or bonds should not be taken as a recommendation to deal. This podcast is not investment, legal, tax or accounting advice. Investors should consult with their own professional advisors for any advice. Issued by Threadneedle Asset Management Limited, registered in England and Wales, number 573204, Cannon Place, 78 Cannon Street, London, EC4N 6AG. Authorised and regulated in the UK by the Financial Conduct Authority. Columbia Threadneedle Investments is the global brand name of the Columbia and Threadneedle Group of companies.